Hi, welcome to the call. This is the 2016 update for October. My name is Troy Patton. I'm a CPA and ABV, and I'm the president of Archer Investment Corporation and actually one of the portfolio managers. Today I'd like to, hopefully you're listening to this call to get some insight as to what the markets are looking like and what they've been doing and obviously what they're headed towards. I would tell you that this is probably one of the most exciting times and nerve-wracking times in the markets. Although we haven't seen quite the volatility that we have come to expect in the past, we may see a little bit more of it as we get closer to the November election. And so with that in mind, I'd like to go ahead and get the presentation started and kind of see where we go from here. And obviously, if you ever have any questions, don't hesitate to give your investment advisor representative a call and talk to them, or they can get you in touch with us, and we're more than happy to talk to you, because I do think now is a pretty interesting time. And there's obviously a lot of questions out there, a lot of questions about what the market's going to do, what our country's going to do, how things are going to behave, and so on. So let's try to cut through some of the chase and see what everybody's doing out there. So right now, when we talk here in the office and we go through our weekly meetings 3 times a week, and we sit down and we talk about everything, one of the questions that always comes up, we always say, well, if the market is so high, what is so wrong? Because there's a lot of things that are wrong with the economy, but there's also a lot of things that are right. And if we want to take a look at just a couple of those things, I mean, look at this chart, and I apologize if the charts are a little bit fuzzy, but civilian unemployment rate and year-over-year growth in wages of production and non-supervisory workers. So basically, unemployment claims are at a half-century low. Whether you like it or not, that's just the way it's calculated. They're at a half-century low. And this indicates that the economy, that we're basically at or close to full employment. Typically, when we're at or close to full employment, we typically start to see some sort of wage growth. And as you can see by the chart in the blue line, the light blue line, we have started to see some kind of wage growth. Here's the other thing. Our wage growth over the next 5 to 10 years is expected to rise. And the reason it's expected to rise is because there are less and less workers coming out into the workforce as there used to be. As the baby boomers are maturing, or they're getting to the point where you may hear some of the unemployment rates include participation rates, and the participation rates are actually low. That means people have left employment. They've felt like employment's not been very good, and they've left the workforce and really don't plan to come back to it. Now, quite frankly, with unemployment this low, you may see more of them come back to the employment ranks and become employed, which may keep wage growth low. However, we believe that a lot of those folks aren't going to return, and that wage growth may indeed rise. And if that's the case, we're likely to see unemployment stay pretty steady here. But, again, our 50-year average is 4.2%. We're running on wage growth, we're running about 2.5%. Our 50-year average on unemployment, on the unemployment rate is 6.2%. We're at 4.9. So I would have to think that these, as you can see, there is some kind of correlation between wage growth and unemployment growth. And I really believe that, albeit from the 70s, with the heavy inflation, that we should see some sort of wage growth, or at least catch up a couple percent to close to touching that unemployment line. In addition to this, the M2 growth, which is basically money in the banks, it's retail money market funds, savings, small deposits, all the corporate amounts invested and saved in cash and IRAs is close to $12 trillion. That's with a T, trillion dollars. And the M2 money supply, as a percent of our nominal GDP, is now running at about 70%. And as you can see, this is extremely high. And it's actually it's up 8.5% year over year, which is up 5% from the previous year. Any kind of GDP model or any kind of model showing this kind of M2 increase typically shows inflation and GDP picking up over the next 6, 12, 18, 24 months. With that being said, I would actually encourage, or that's probably a little bit of an encouraging sign, because we do want to see inflation pick up a little bit, because we've actually seen some signs of deflation, albeit not necessarily in certain goods. Maybe, for instance, like a big TV, a 50-inch TV may have been $1,000 before, and gosh, you can get them for $400 now at Costco. So, we probably need to see some inflation and some decrease in the dollar, frankly, to help increase profits going forward. I do want to talk a little bit about interest rates and some things like that, and just a quick cartoon. No, just hear him out. Maybe we are being too defensive. In the past, we've been very defensive on interest rates, saying that interest rates had to move higher, and quite frankly, we've been incorrect on that. We really still believe that interest rates have to move higher at some point as soon as the government interference gets out of the way. Now, we can argue politically, whether that government interference has helped or hurt the economy, whether it's helped us with the unemployment rate, or whether it's hurt our comebacks of steady GDP growth over the last several years, which has been very anemic at best. But it's still worth mentioning and talking about interest rates and how they are going to impact the economy and so on and so forth. Okay? But before we do that, let's talk a little bit about earnings. Frankly, earnings in the United States and the larger companies have really been non-existent. I mean, there's been no growth. I shouldn't say they've been non-existent. There's been no growth in these. In fact, as you can see from the chart here, the blue line is every quarter we figure out what the earnings have been, and if they are higher than the prior year, same quarter over quarter, and then whether they're higher than the previous quarter. And quite frankly, folks, this is the first time we've seen that blue line above the prior year and prior quarter all at the same time on the quarter-to-date numbers. So although I'm encouraged, as you can see, earnings have really stagnated here. And the S&P 500 change in forward 12-month earnings per share versus the change in price over the last 10 years that you can see in that blue line, it's really been non-existent. Now, the S&P has risen, and frankly, as you can tell, the S&P 500 is not going to rise unless earnings rise. Okay, I mean, those are the facts. There's two things that are going to affect our stock market. One is higher earnings, and two is higher inflation. And one or both of those have to exist before we see the market move higher. Okay. Here's just another chart showing our earnings and basically the estimates of earnings. And the estimates of earnings is this these green bars, and it's basically is what it is. It's the consensus analyst estimates over the next basically 18 months. Now, I will tell you that we should have some positive things going on here, and I mentioned this last quarter, and it's the year-over-year percentage change in the U.S. dollar. I would expect that the U.S. dollar would be weakening here at some point, although we haven't seen that as of yet. In fact, over the last 7 months, it's actually risen here a bit. But we should see that subside at some point in time, as long as the Fed kind of gets out of the way and they continue and they don't go out and extraordinarily expand their balance sheet like they have in the past. We should see the dollar fall just a bit. And in addition, we've just come off probably one of the worst times in the energy sector in terms of the falling price of crude oil. And that falling price of crude oil is obviously dramatically hurt earnings for the energy sector. And so we should see that start to rebound as we think oil stays around this $50 level that it's at currently, and even frankly moves closer to maybe the upper 50s to even possibly the low 60s over the next 12 months. That should bode well for the energy sector and start to put more profits in the coffers of those companies and obviously expand earnings for the S&P 500 companies. Well, as we talk about these earnings and where the market's at currently, we actually can see that the market from a historical standpoint is somewhat overvalued in terms of a 25-year average. of earnings. In fact, the forward estimate of earnings, it's running at about 16.8 when the average is right around 15.8. Now, I would like to point out to you that although that appears to be overvalued by some measures, there are some measures where, frankly, it is a bit undervalued in terms of dividend yield. The average dividend yield of the S&P 500 is about 2.2%. The 25-year average is about 2%. That tells us that we're about 0.4 standard deviations away from where the market should be, which would make the market rise to a significantly higher level, or at least I would say maybe a couple hundred points on the S&P 500. Again, the same with price to book, and probably more importantly, and I think most importantly, is the earnings yield spread. And that earnings yield spread, as you can see here on the bottom, is 1.7%. I've got another chart here in a bit that's going to explain this in a little bit further detail. But the earnings yield as of October, based on the past 12 months for the S&P 500, is running about 5%. That means if you were in the S&P 500, it's growing at about 5%. Well, the yield on the 10-year Treasury is about 1.72%, and on a 10-year AAA corporate bond is running around 3%. So the question is this: would you be willing to put your money away for the next 10 years in a Johnson & Johnson bond earning approximately 3%, or would you rather put it into the S&P 500 where you have earnings yield running about 5%? Now, quite clearly, that does not mean that the stock price is going to appreciate every year 5%, but it typically means that we can expect about a 5%, at least a 5% appreciation in the earnings yield of companies at this point in time. And I would tell you that, that 5% along with a dividend equates to about a 7 to 7.2, 7.5% return on our investments over the next 12 months. And typically that's what I would be expecting. The one thing that can make that rise higher is frankly the fact that the market trading at where it's at is at about a 5%. If the market moved much higher, that 5% would begin to decrease a bit and get closer to the 10-year corporate bonds and 10-year Treasury bonds, which would make the market more fairly valued. So at this point, I actually believe that the market's somewhat undervalued based on where we're at. If we're going to see a rise, in earnings. And in fact, I would tell you that it's very possible that interest rates could rise. In fact, as I said before, we've been wrong and too defensive on bonds for some time. And if you look at this chart, basically what this chart is showing, it's showing the secular movements in a 10-year Treasury. And as you can see, this last red line down is where we're currently at. So we have seen the 10-year Treasury rebound to 3% back in 2014. But since then, it's declined again. And we've been in the same cyclical pattern, really since the 1980s. And people have made a lot of money in the bond market. I mean, the 10-year Treasury at one point went over 15%, as you can see. And now we're right around 1.7%. Is this the bottom? I don't know. I mean, the secular pattern shows that it could possibly continue to move lower. Although, I think we'd have to possibly see some sort of recession for that to move lower, where people move more money into the bond market than they do the stock market. So at this point in time, I would tell you that that's probably unlikely to happen. But it's also somewhat of a self-fulfilling prophecy, and you can actually see this bottom portion. This whole leg down here, the secular portion, is summarized here. So you can see it how it appears here, and we can see that we have hit 3% back into 2014. But let's just say interest rates rise, for instance. Let's say they go back to 3% on the 10-year Treasury. Well, the one thing that we can kind of look at then, and we'd say, well, if it rose, that would make the market skittish, and housing would decline, and people would quit getting mortgages and that sort of thing, and they'd quit building. And if that did happen, then what would happen is the market would falter a bit, and interest rates would come down as more people put their money into bonds as more of a safety net or a source of safety, and it would drive those interest rates back down, and then once again we would go and do the same thing again. So we're in this secular cyclical pattern of lower interest rates. Things get healthy again, the interest rates rise, things fall off, they go back down, and so on and so forth, and it keeps repeating and repeating and repeating, and each time we've taken a little bit of a leg lower. Now currently we're at 1.7%, and I would tell you that we have not hit down to that 1.36% level again, although we have nearly bounced off of it here over the last month or so. So it's going to be interesting to see if we break through that level and we create another bit of a cyclical secular downturn again. That's I guess pretty difficult to say. So that's kind of where we're at when we look at the earnings yield of the S&P 500 as well as it's compared to the 10-year Treasury and the 10-year corporate bond. Now, when we equate this back to the earnings, as you can see here, the green and red, I'd much rather see more St. Patrick's Day colors than Christmas colors, because St. Patrick's Day colors means that it's basically the percentage of S&P 500 companies with positive and outlooks for their companies. And as you can see, the financial industry, the big banks, everybody's pretty positive. Obviously, they've learned how to make money in these low-rate environments, and if rates rise, that'll continue to move those company stocks even higher. In fact, as of this morning, J.P. Morgan had a pretty good earnings report, beating on the top line of revenues and the bottom line of earnings. So we may see that continue to move forward. However, it looks like a lot of companies where utilities, for instance, and telecom services have all gotten much more negative. And part of that, I would suspect, is really due to utilities have been slowing. They've been trading at extraordinary multiples only due to the low interest rates, and I don't foresee those companies continuing to do as well as they have in the past. So really, the question comes back to this. We think inflation's in check. We would say that's probably the case. We would also say that we're in this cyclical pattern of interest rates up and down. So what can move the markets higher? It's really earnings, and I think that's really the bottom line. We need to see higher earnings. As you can see by this chart, even going back, into July, the market's been really stagnant because we have to see some guidance from the big companies in terms of their earnings moving higher. And we've tried time and time again to bust through this line, and it really has been a snooze fest. In fact, we've seen we saw a record 75-year volatility measures. That means the market moved up and down by the least amount of time. We did see the S&P try to break out in August and September, only to kind of throw it back and broke our resistance right back down into this pattern. I mean, this is a little bigger shot of kind of where we are in the S&P 500 over the last couple of years. But really, the S&P 500 over the last 2 years really has not moved much. Yes, we saw a couple dips down, but as interest rates got back down again, it spurred more incentives and got us right back up. So we really need to see the markets moving higher. With the 10-year moving a little bit higher here lately, we've seen utilities start to decline, and that's in the red. That's in the red, and the financials are in the black, and that's really started to move higher. Oftentimes, a lot of people think there's a couple things that drive the market higher, and that's earnings in transports and financials. And really, until we see those earnings in the financial sector start to rebound and we get off a lot of this government regulation and the headline risk of those companies, we really think those companies are going to do pretty well and move the market higher. We say this because really the market, I would say the market statistics and the market internals and the vitals of the market are doing quite well. In fact, we've had new all-time highs in the advanced decline line, and that means the volume of advancing shares is much higher than the volume than the number of shares with lower volumes and declining shares. So the advanced decline line is something that we watch on a consistent basis, and it really does lead us to kind of where that market is headed. In fact, if we go back, into June and July, and there was a period of time that we showed you, and if we could expand this even further, that it was much higher, and we always said, in fact, I think it was in the last quarter, we said we need to see that advanced decline line rebound, and where more companies are participating to really the tide lifts all boats, and that will lift the market much higher. So we're still kind of waiting for that. We feel like the consumer's in great shape. As you can see here, household debt services in the third quarter of 2016 is really running pretty low around the 10% level. Obviously, you can see in the fourth quarter of 2007 it was about 13.2%, quite a bit higher there. Household net worth has continued to rebound. Total assets of the consumers has increased, as well as mortgages decreased. We think those are all positives. Here's some more just good information. Housing affordability continues to be low, and that's really driven by low interest rates. The average interest rate on a U.S. mortgage, again, continues to be low. Obviously, this does hurt seniors in terms of what they can earn on interest rates and CDs and things like that, but overall, it's what's propelling our economy. And although I hate to see it for those folks, hopefully there'll be some opportunities for some rising interest rates, and as it's pushed a lot of those investors out of those CDs and really into those utilities and dividend-type paying stocks. Okay, so the next slide here, it's really the percent of months in which the S&P closed higher than it opened. And this is from 97 to 2016. And the reason I put this up here is we're in October, and we typically see about a 2% increase in the stock market. And I really do believe that that the market's going to keep moving higher in October, November, December. You can see here it's pretty easy that these are some of the best months typically from a return standpoint in the stock market, and we think this is going to be no different. So we really possibly believe that the market could move anywhere from 2 to 5, even 7% higher going into year end. With that being said, we know that the market always moves higher and lower in any given year, and as you can see here, and we put this chart up all the time, just because the market moves higher does not mean it can't move lower. In fact, typically, any market that moves higher on a consistent basis is probably setting itself up for some pretty good failures, as we did in the past in 2001, 2002. Those previous years were they were just running up high, and nobody believed, that the market could settle down. But those red numbers, really, all those do is those insinuate that the market can move lower, and in fact, off their highs of each year, they do tend to move lower, even though the market has moved higher by year-end's time. So the market is going to be volatile, even though we haven't seen that for the last 3 months. I would expect more volatility on the horizon, especially given the election and polarization of the two candidates that we have currently. This next slide really just shows that the average investor continues to only make about 2.1% when the S&P 500, or a good 60-40 moderate allocation without taking a whole lot of risk, and I shouldn't say a whole lot, but I mean a much subdued risk, has ran about 7.2%. So again, diversification is the key. That's where I would keep investing in a diversified portfolio. I think that's very positive for the investor. And again, staying in the market over time. I know we've had people that have tried to time the market, and people think they can time the market. I'm here to tell you it doesn't work. I mean, if somebody had a market timing mechanism that was foolproof, everybody'd be doing it, and everybody'd be making the money on that. So it really doesn't happen. The key is the United States, as we've said, they're undefeated in comebacks, and the market, we believe, will continue to move higher, although we need to see our earnings support that higher move. Okay, the market's going to get a little bit more volatile. We know that. Again, I always put this slide up here because I do think it's I do think it's always a good time to invest if you're investing for the long term. And if you are investing in the long term, I do feel that that's important. The long term really should be over a 5-year period or longer. And if you have a long-term horizon, as long as your goals do not change from that, I think the market's a great place to invest. If you do have cash needs over the next year, I'd probably be hesitant as well, and quite frankly, I'd be keeping my money into a fairly liquid ETF bond fund or something like that. With that being said, I appreciate everybody's time, and if you do have any questions, again, do not hesitate to give us a call or call your investment advisor representative. Thank you very much for attending, and we appreciate everybody being on the call today. And if you ever have, any questions, don't hesitate to ask. We always appreciate referrals, and I know your investment advisor representative that you work with, that they appreciate them as well. Thank you.